Good morning, children. Today we will study about factors affecting capital structure. The first factors that affect the capital structure of the business is cash flow position. You should know that what is capital structure? Capital structure is the proportion of debt to equity. Debt is basically the borrower's fund, equity is basically the owner's fund. Now, what are the factors that affect the capital structure? The first is cash flow position. The size of the project cash flow must be considered before deciding the capital structure of the firm. If there is sufficient cash flow, debt can be used. So, how much debt should be kept and how much equity should be kept is decided by the cash flow position. If there is high amount of cash flow in the business, then debt can be used to finance the business. It must cover fixed payment obligations. So debt must contain the fixed payment obligation. What are the fixed payment? That is normal business operation. So payment for the normal business operation. Then investment in fixed asset, money required to invest in the fixed asset. Then meeting debt service commitment as well as provide a sufficient buffer. Whatever debt service commitment is required, that should be fulfilled, provided by a sufficient buffer. So all these include the cash flow position of the company. If the cash flow position of the company is good, the money coming in the business can repay the debts of the business, then debt financing is the best way, and the company should increase the debt in the business. The finance manager should increase the debt in the business. The second is interest coverage ratio. Higher the interest coverage ratio, which is calculated as follow: EBIT, that is earning before interest and tax, lower shall be risk of the company failing to meet its interest payment obligation. So if the interest coverage ratio is less, that is the company is not able to pay the debt of the business, then less debt should be used in the business and more equity should be used to run the business. And as I have explained you, capital structure is basically the debt is to equity. A combination of both is required to make a capital structure, and higher the interest covering ratio is there, lower shall be the risk of company failing to meet its interest payment obligation. As a result, the interest coverage ratio should be taken into consideration. Third is debt service coverage ratio. Debt service coverage ratio is basically the profit after tax plus depreciation plus interest plus non-cash expenses plus interest plus repayment obligation. Means every debt has certain amount of coverage ratio. If the debt service coverage ratio of the company is less, then equity should be used. So a higher debt coverage ratio in which the cash profit generated by the operation are compared with the total cash required for the service of the debt and the preference share capital, the better will be the ability of the firm to increase debt. So if the higher debt service coverage ratio is higher in the company, then more and more debt should be increased in the capital structure. But if there is low debt service coverage ratio, then the less debt and more equity can be used in the capital structure. Now the fourth factor that affects the formation of the capital structure is return on investment. If return on investment of the company is higher, the company can choose to use trading on equity to increase EPS, that is, its ability to use debt is greater. So if the return on investment is higher, then its ability to use the debt is greater. So more of debt should be increased in the capital structure and less of equity should be used. The fifth factor that affects the capital structure is cost of debt. More debt can be used if cost of debt is low. So if the cost of debt is low, then more debt can be used, but if the cost of debt is high, then less debt can be used. The sixth is tax rate. A higher tax rate makes debt relatively cheaper. So if the tax rate is higher, debt is cheaper, and as a result increases its attraction as compared to equity. So if high tax rate is there, then more of the debt becomes cheaper and more debt is used in the capital structure, while less equity is reduced. The seventh factor that affects the capital structure is cost of equity. When the company uses more debt, the financial risk faced by the equity holders increase, so their desired rate of return increases. When company is used more debt, so when the company is using more debt, then there is a financial risk. Why? Because if they will not pay the money to the bank, then the bank will close the business. So a limited amount of debt should be used. So if the cost of equity is high, then more of the debt should be used, and if the cost of equity is less, then more of the equity should be used in the capital structure. Now the eighth factor is flotation cost. Cost of public issue is more than the flotation cost of taking a loan. If the flotation cost is high, what is flotation cost? Flotation cost, we have already explained to you that while issuing the shares in the company, while issuing the shares of the company in the share market, lots of expenses are required. That expenses is called the flotation cost. If the flotation cost is high, then less of equity is used and more of debt is used. The ninth factors that affect the capital structure is risk consideration. If the manager wants, or if the owners want to make the business risky, then more of the debt should be used. But if they want to make the business less risky, then more of the equity should be used. The 10th factor that affects the capital structure is flexibility. If the business wants to be flexible, then less debt should be used, and if the business needs to be more flexible, then more of the equity should be used. And then the last factor that affects the capital structure is control. If the shareholders want full control of the business, then more of the debt should be used, and if the shareholders wants to dilute their control, then more of the equity should be used while making the capital structure of the company. today only this much. Thank you.